Hey guys, this is Mayor from the Goldcast, and today I'm going to respond to a video by Graham Stephan where he gave his thoughts on gold, specifically as an investment. Graham is a personal finance YouTuber and real estate investor, and he had a lot of interesting things to say, so I'll play the entire clip and then I'll give a few comments.
Anyway, we have another topic that a lot of people have been asking me to talk about, and I haven't really addressed it much until now, and that would be gold. What brings us to our attention today is that gold is now trading above $1,800 an ounce, which is the highest level we've seen since 2011. Now this one I think is pretty understandable, because typically investors flock to gold as a hedge against inflation and just as a safe store of value during economic uncertainty. So for anyone who believes the dollar is going to be going down in value and they don't believe in the market and they just want to protect their wealth, then gold can absolutely do the trick. That's why with everything going on right now, people see gold as a safe store of value, and as demand increases, the price goes up. However, for anyone wanting my thoughts on this, I do gotta say, you know what, I'm not a fan. I think it definitely can have a place in your portfolio, but I wouldn't be calling it an investment, just like I would not be calling a savings account an investment. I think it could absolutely work in certain situations, but buying gold should never be the end goal. It's something to hold on to in case of an emergency, but it doesn't produce anything. It doesn't provide you with a dividend. The transaction costs to buy and sell are pretty high. So I really don't recommend keeping much money in gold, and for me personally, I have very little of it in gold or any sort of precious metals besides coins and a watch. My main issue though when it comes to gold is that historically it's just been a really terrible investment. Just compare it with the stock market over the last 100 years. Even though the price of gold is up over 8,400%, the stock market is up over 26,000%. Even since 1990, the price of gold has gone up 500%, but the price of the S&P 500 is up almost 1,500% with dividends reinvested. See, generally over the long run, stocks outperform gold by a rate of 3 to 1. But yes, during a volatile short-term outlook, gold can come out ahead the winner. Although my thought is this, generally by the time gold hits its peak and just soars in value, that usually just means stocks have taken a hit and they're more attractive in comparison. See, the price of gold usually goes up when our economy is going down, so if you're really trying to time the market, most likely the time to have bought gold was in 2015, where everything was going just fine and everything was pretty uneventful. That's when there was the least amount of demand for gold because really nothing was going wrong. Investing in gold in 2011, for instance, would have been a really bad move in hindsight, because once the stock market began turning around, gold began going back down after hitting its peak. Now, I'm not saying gold is bad, don't invest in gold, because it can have a place in your portfolio and it doesn't hurt to keep a small percentage of your wealth in precious metals just as a store of value. But when you look at this historically, gold has been an underperforming investment. I know people get upset when I mention this, but when you look throughout the last 100 years, stocks have outperformed gold by a long shot. So even though gold is quickly approaching its previous all-time high, I personally am not investing any money into it, and I encourage you to seek any other investment if you're looking for something.
Okay, so Graham made some interesting points, and I'll try to cover some of them in order. So he started by saying that gold does not produce dividends, and it actually doesn't produce anything. Obviously, I would not argue with that. Nobody can argue that. It's just a fact. The next point he made was a lot less straightforward, and I think it's a little bit deceptive, honestly. I don't think it gives a clear picture for his viewers or for people who are just learning about gold and considering it for the first time when they hear the news about recent price increases. And I'm going to show the exact same chart that he had, and I'm going to explain why I think that's the case. So this is the chart, and it shows gold price versus the stock market price, Dow Jones Industrial Average, for the last a little bit over 100 years, going all the way back to 1915. And yeah, so obviously starting at zero, going all the way up here, we have the stock market increasing 42,000% and gold increasing 8,000%. So what does that mean? Well, the trick is the part where gold and stocks deviate right here. This is where the magic happens. Stocks going from here, and this is the year 2000, by the way. So in the year 2000, stocks were already at 17,000% growth. From that point on until here, they only about doubled. So from here to here, it's only about 2x. Versus gold from here at 1,370% to over 9,000% as of this month or last month. That is much bigger, and that's over the last 20 years. So, Graham and I were both born in the 90s. We never did any financial transactions in the 20th century. So saying that this period of historical economic growth due to many factors, the invention of the internet, globalism, the American dream, whatever you want to say, caused this huge spike in stocks here, that's not a historical norm. That's not what you plan your entire life on, that this is going to keep happening, this is going to happen again, this is always going to happen. That's a huge aberration historically. That is not the historical norm which Grant presents it as. And likely that will never happen again, at least in this country. So what we can expect is maybe, if things go well, maybe stocks will keep going from here to here over 20 years. I don't think it's going to go that well, honestly. In the long term, I don't think it's going to be that good. But if we're looking at the 21st century, this is the data we have. Looking back at, growth in the 80s and early 90s, that's not really what you should be looking for, honestly. How does that affect 20 years of data that we have in the modern economy? How does that affect, how do you expect that to keep happening? Why is that only happening in this tiny 15-year window here? Why is it not happening all throughout this part? Why is it not happening for the last 20 years? So, I would really like, if Graham thinks that this is the historical norm, that stocks are always going to keep doing this much growth, really what he needs to say is the growth is here. If you look at this chart, it all looks like the growth is happening right now. It's not. The growth is from when gold and stocks were about 2,000 here to 20,000. So that's a 10x. This is a 2x. So this chart is extremely deceptive if you don't know what you're looking at. And in this chart, gold actually looks a lot better for me, because over the last 20 years, it's done way better. And that's the time period I'm looking at. I'm not looking back to historical economic periods when central banks were doing things differently, and interest rates were completely different, and the entire economy was just totally different. I think that if we look separately at these charts, so I'm going to switch pages here. This is the S&P 500 historical chart data for the last 20 years. So this is only 20 years. This goes back to the year 2000, July 2000. And this chart is this. Doesn't really look the same here, does it? So, granted, this is the S&P 500, the other chart is the Dow Jones Industrial Average, but it's relatively similar. This is gold over 20 years. So, it's a lot of spikes down, and if you look at the actual number differences here, we're talking about a 50% increase versus if you had gold here at 400 and you sold it here, you'd have about 4.5 times your money. And even if we choose something like this, and here, that's almost the same growth as the entire part from here to here. So that's what this guy's not telling you. And you really need to think about these charts deeply and understand what they mean, and not just look at these huge historical charts and say, okay, stocks. because this chart is extremely deceptive for people who don't know what it means. So that was my biggest problem with the information that Grant provided his viewers. One of the other things I want to consider is Grant really tried to make the case very heavily comparing gold and the stock market. I was left wondering at the end of this video if Grant was suggesting people to put 100% of their money in the stock market, because he couldn't obviously show another investment that would outperform gold. Obviously, bonds with negative interest rates effectively, if you calculate for inflation, that's not going to be making you any money. And what other, CDs, like, no. So, okay, great. Let's say I agree with Graham. Let's say I think stocks are better than gold. Am I putting 100% of my money in stocks? So what do I do with the money that's not in stocks? So, Grant, obviously he's in real estate, so I'm sure that he would say, well, for him personally, because it's his expertise, it's his life's passion, he would put his money in real estate. But for those of us who aren't real estate experts, what are our other options? I think there's a strong case that you shouldn't put 100% of your money in the stock market, even if the majority is in the stock market. And for that money that's not in the stock market, are you just going to let it lose value over inflation constantly? Are you going to try and get tiny interest rates? I would say gold is a better bet. Yeah, so again, I don't think stocks outperform gold in the long run, as Grant claimed. I think the situation which happened with the global economy, which had to do with technological innovation, which is not being repeated ever again, had to do with mass production, had to do with globalization, had to do with the fall of the Soviet Union, had to do with all these different factors, the internet. That was a historical aberration, guys. So I would just urge everybody who's looking at these charts, look at them very critically, and don't just let somebody quickly tell you, guys, look at this chart, stocks are so much better than gold, end of discussion. Don't dismiss gold that quickly. So one interesting point Graham made, and I thought this was actually an interesting idea, he said, instead of buying gold, you should just wait until stocks go down and buy the stocks. Now, he did say you could also just buy gold when it's cheap, when everything is going good, and then sell the gold and buy the stocks. I don't think that's a bad strategy, and I wouldn't really argue with him on that. I think that's actually an interesting idea for money that you're willing to kind of trade and, take some chances with and try and grow and take on a little bit more risk. Buying gold when it's lower might be a good idea, with the idea of selling it when the price gets higher and buying stocks. Obviously, you have to be careful in a situation like this, where the reason that the price is higher is because we have a very uneasy situation globally with socioeconomic conditions, including a pandemic. So, it's a very extraordinary situation, but in general, I think that's an interesting idea, and I wouldn't say that if you did that, let's say in March, if you sold some of your gold and bought stocks or bought equities, that might have been a good financial decision. So I would definitely keep that in mind. And one more thing which he stated very accurately was that gold has high transaction fees. And this is something that is a reality. And for people who are considering making shorter term trades with gold, maybe look into paper gold. There's some blockchain projects, Paxos, many others that have tokenized gold. Very low fees, very fast, extremely liquid. So that kind of takes away some of the things that he was saying. Obviously, there's a lot of criticism of these ETFs and such. I won't get into that in this video, but there are options if you're looking to trade gold without obviously having the high transaction fees of buying physical product. But in the long run, obviously, if you're investing over the course of years and years, you should own your gold. Alright, thanks guys. So I think it was an interesting video, and I hope you guys learned something. And just remember, keep gold in mind and really give it some thought. Don't just let people say, I don't like gold, or only stock market, or only this, or only real estate, or that. It's always good to have a diverse portfolio and consider multiple different things for different situations.